guys had your 25th anniversary this year, so it's 100,000 BOE a day international and North American oil producer. They've got assets in Europe, Australia, obviously Canada, United States, Australia. Lots of interesting things to talk about, as always, with Vermilion, and representing the company today is President and CEO Tony Marino. I've offered Tony the chance to give some opening remarks, so feel free to take five minutes or however long you want to talk about the investment thesis or whatever's topical. I'd also remind you guys that we do have an app where you're allowed to submit questions, so feel free to either put your hand up to ask a question, or you can submit one anonymously online, and I'll try and ask Tony. So with that, I'll hand it over to Tony, and look forward to getting an update today. Thank you for coming by.
Yeah, thanks, Dave. Thanks to CIBC. Great place to have a conference. Glad that you guys have stuck with it. You know, on this introductory set of comments, I was actually going to skip them. I kind of liked your one-minute introduction, and you know, we could go right to questions.
Yeah, terrific. I guess with that in mind, the first question that I had was just on ESG. I think that's become extremely topical, especially over the last 12 months. Even though I would say Vermilion, for as long as I've known the company, I would say you guys have been an industry leader in the topic. You guys have been publishing sustainability reports for quite some time now. You guys have always played up, you know, some of the initiatives that you take in Europe and things like that. So, just with that in mind, I guess I wanted to get a sense from you. What are your top priorities on the ESG front in 2020? And perhaps can you give us some examples of areas within ESG where you guys might differentiate yourself from other producers?
Oh, for sure. Yeah. I mean, I think this is a really important topic. Everybody in this room knows how difficult it's been in the industry, and I think this is probably one of the top two reasons. Maybe it's second. I think the first reason we've run into so many problems with public market performance has just been really the poor returns for a long time from the industry and the low return on capital. But I think a second one is this concern that everybody probably has about the long-term future of the industry. You know, a concern maybe that the product demand is going to go away shortly. There's a whole lot of ways to think of this. Maybe that a lot of investment is going to be stranded either geographically or stranded in time due to lack of market. So it's really, really key, and undoubtedly it's probably hurting the sector in performance and in multiples. So as you pointed out, it's been a big area of emphasis for us. I know I've been pushing to to publicize the sustainability initiatives that we've had for a long time, to really up the reporting and to expand our efforts in the company. So in response to your question about what are we doing, there's quite a bit of material in the presentation about this, and maybe I've got to go straight through. I'll skip over some of the background, but on our efforts, and maybe just go to some of the, first of all, overall results in the company, and then a couple of specific projects that we hope can maybe be a little bit of a guide for the industry to show that oil and gas can be perceived, can be perceived as a long-term, maybe to some extent even renewable industry. So first of all, in the overall efforts that we have here, we have put a lot of emphasis on getting accurate reporting into this large number of agencies. We do have audited submissions that go in. It has turned out to date that in all these areas of ESG, for the governance, for the environmental performance, and for the sometimes neglected social performance, we have made it into the top quartile within the energy sector. So that's very important to us. In fact, it is even part of our long-term compensation assessment. Our scoring versus the peer group determines part of our LTIP proceeds. So in the area of carbon specifically overall, I'd point out that the company is A- rated by the CDP. We've been at the A- level each of the last 2 years. We were A before that. There aren't any energy companies in the world, and I think this applies to the renewables as well, that make an A rating. So A- has been the top level you can make for oil and gas, at least for the last year. There's 13 companies that do make it, and again, this goes beyond just specifically oil and gas companies. I think the A- level includes some renewable companies. There's only 2 North Americans. The other one is Hess. There's no other Canadians at this level. We got there because of the completeness of the reporting that we've had on carbon, and also because of the emissions intensity reductions that we make. One thing, when we acquire a new set of properties like we did with Spartan in Southeast Sask, it is our intent to improve their emissions profile. Spartan, did a lot of things well. I don't think they put a huge amount of emphasis on carbon and methane performance. So, it probably leads to a calculated increase in our intensity, but the whole objective that we have is to bring down that intensity over time so that we make a real improvement in the amount of greenhouse gas that goes into the air. And, we intend this to have, certainly we intend it to have an operating impact, less energy input into the process, less flaring, fewer spills. All of these things lower our costs over time. They make us a less risky company. And furthermore, it is intended to have a positive capital markets benefit, hopefully to expose us to some SRI AUM, growing active AUM and SRI that we wouldn't otherwise get to. We've had some success in this regard. I know that we have attracted a new SRI fund out of the UK, actually a fund specifically devoted to looking at companies that make improvements in operations, and that is why they said they put us into their portfolio, only oil and gas issue, and that was a fairly big UK institution that launched that fund. The other purpose in the capital markets is to try to, if we can, immunize the company to some degree versus disinvestment. I don't know how practical that has proved to be to date. You've had parties like CalPERS and State of New York, City of New York get out of the industry. I don't think they owned us to begin with, so maybe there it didn't make a huge difference. Others like Norges, who said they got out of the energy issues to diversify their exposures, but it was kind of perceived to be in part environmental. They did own us, and we weren't able to prevent that. The reason I think it is important to do that is that, we know that to some extent there are going to be institutions that do specifically sell the energy issues, and also I think that the effect is bigger than the actual divestments, because I think other investors are worried that there is going to be divestment over time. So part of our goal is to try to immunize against it, and we have the CDP rankings. We also have this is Scotia's assessment of CO2 intensity for the Canadian sector, and we rank very highly there. So these are the overall efforts that we have in the company. I want to specifically touch on, I know this answer, I'm looking at the clock going on a little bit long in sustainability, but an important topic. We have a number of projects going on in Europe that illustrate how I think oil and gas can actually be to some extent a renewable industry. The first is at Parentis Lake, southwest France near Bordeaux. We have a light oil field that is the largest onshore light oil field in Europe. Produces from 2,500 meters. It's a water flood, pretty high water cut. Water comes up very hot. We run that water through a heat exchanger, and it is used to heat 15 hectares of tomato greenhouses. An ag entrepreneur and Vermilion put this project together. Those greenhouses that are heated with our otherwise wasted energy, our recycled energy, produce about 5 million kilos of tomatoes a year. Started an industry that now employs 350 people there. It's 8 megawatts of power. There's a huge amount of energy content in this hot water, and that's how much is being recycled through this project. Truly renewable. The water goes back in the ground as a water flood. We bring up more, we just cycle more hot water all the time. Similar project, it's 3 megawatts, very near there in Le Test in southwest France, heating a apartment complex. This complex is intended to be entirely sustainable in a lot of ways. We provide the energy to heat the water and to have the space heating. Also, there's an economic inclusivity component. 40% of the units here are low-income housing. So these are the type of efforts that we have going, and we're trying to promote to try to demonstrate that you can actually have a geothermal component to your oil production, which is really a renewable, because we're not cooling off the formation It is continually available to us as hot water, again, used in the water flood. So this is really what we're trying to achieve. And our basic thesis is we know there's an energy transition. We're a part of it. And we think if you're a concerned citizen, investor, community government, you should turn to the best-in-class producers during the energy transition, because there's going to be a lot, and in fact increasing quantities of even oil, and certainly even more increasing quantities of gas consumed over the transition. I know that was a pretty long answer, but it's an important topic.
Well, no, you guys have some good material on this, so I'm glad we spent some time on it. So the next question I wanted to turn to, and I'm sure this is another question that you get quite a bit lately, but it's about the dividend yield. Your current presentation, you guys show a payout ratio of less than 100%, but nevertheless, your dividend yield is currently 13%, which is somewhat high by historical standards. So I just wanted to get a sense of your view of, investors that look at your dividend yield and see the 13%. Should this in any way be interpreted as a sign that the current dividend is unsustainable? And what would you say to investors that might be wondering, rightly or wrongly, whether you're considering a dividend cut?
Yeah. I mean, well, apparently at a 13% yield, there would be a market concern in some quarters that the dividend's not sustainable. Otherwise, why would it yield that level? But that's a concern that we don't, I guess, we don't completely get. And part of it is looking at this slide 15 on total payout ratio. You guys have all probably seen this format before, but the black dashed lines, 100% of the available cash flows each year. Blue is dividends. The dark blue is cash dividends. The light blue is the DRIP that's existed and now is being phased out this year. The red is our CapEx program. So the first overall point I'd make here is that we did this a couple of weeks ago, but doesn't matter which day you do it, we're actually at the lowest projected payout ratio than we have been at since 2008. And back here in the first 6 years of the decade, when these payout ratios are significantly above 100%, we weren't getting this question. We were trading as low as a 3.25% yield. So we think that in terms of pay as you go, we actually are in the best shape that we've been in for since the financial crisis in 2008. So I guess we don't agree with the contention represented by the 13.25% yield that we're at today, that this dividend is highly precarious. A second facet of this thing, it's kind of like goes back to even the first question, all this difficulty in the sector that we have had, and the whole sector has had in the public markets. You used to be able to run more than 100% payout ratio. We've smashed down the costs, especially on the operating side and G&A, but especially on the capital cost side, where we're down to, we're 70, depending on which currency you want to look at, Canadian or CAD, we're down 75 to over 80% in organic F&D. We're definitely at the highest free cash flow we've generated in the company's history, as represented on this slide. Cash flow on the left, FCF represented by FFO minus E&D CapEx on the right. Definitely the highest FCF we've been in the company's history as a result of bringing down that CapEx. And also with respect to the DRIP, these DRIPs were kind of a facet of the trusts and then the DivCos, and I definitely felt it was important to bring down that DRIP discount over time. We eliminated it completely in Q2 of 2018, but now even an undiscounted DRIP has been intolerable, and I do want to get this phased out because I don't like any equity being issued at this price. But we're no longer, relying on a DRIP. We did use the DRIP a little more heavily in 15-16 while we're making the adjustment to this lower commodity world and this L-shaped recovery that we've had. But all these significant improvements, yet today at a 13.25 yield, I'm not sure I completely understand this. And just think about this in the most simple manner. Rule of 72s, you could buy this issue, and as long as we pay that dividend for 5 years, you reinvest, you'd have your money back, and you'd still have a share of stock at that time. So, we've maintained that dividend. We've increased it a few times, and I don't think an increase is in the cards in the short or the medium term. That's not going to happen. But we've maintained it through thick and thin, and to be at this status that we're at today, and then to say that the dividend is unwarranted doesn't really make that much sense to me. Sometimes I get the question, do you guarantee you're never going to cut the dividend? Obviously, we're not going to put that kind of guarantee out there. It'd be completely disingenuous to do that. Undoubtedly, there's some combination of, permanently lower oil price and maybe just duration of that lower price time that would cause us to reevaluate. So we're not going to make that kind of guarantee. But you have to look at our funding status today and consider that we have never cut it to date, and it shows you something of the company's determination and relative position versus where we have been in the past.
All right, and I just wanted to link up the discussion about the dividend to financial leverage, which is another question I get a fair amount. You guys, I believe it's in this presentation, you're on track to end year-end 19 with a trailing debt to cash flow ratio of about 2.2 times, which is also somewhat high by historical standards. So can you just talk about why you're comfortable running with a higher level of debt, at least measured by the debt to cash flow ratio, than you have been in the past? And how would we expect to see Vermilion de-lever over the next couple of years?
Okay, so that... another good question. I think I've got 3 or 4 slides that would cover this. So the first is on this slide 34. I'd like to just make clear what the composition of our debt is. So this is on the pie chart. We have $1.6 billion drawn on our bank facility with CIBC and all these other banks that are listed in the syndicate. Canadian banking sector is a tremendous, I think, resource for the country and for this industry. It's great to have that kind of support. We've got Wells Fargo, the important U.S. banks in there, a little bit of international banks. It's an incredibly strong syndicate. That's $1.6 billion and $500 million undrawn. We try to, with another $400 million accordion that would be available. So we try actually to hold down that that committed but unutilized slice there, that $500 million, because we do have to pay commitment fees on it. It's something on the order of 1%. We're trying to limit our interest expense. We don't intend to pull on any portion of those open pie slices there. So that's $1.6 billion. That is a covenant-based 4-year facility. From July 1, 2019 to July 1, 2023, that is a committed facility by that set of banks based on the covenants that are shown on the upper right part of that slide. We are light years away from those covenants. This is not an RBL. It is not subject to redetermination based on a bank price deck. It is only openable if we break a covenant. You can see, our interest coverage at Q3 was 13.4 times by the definitions used in the credit agreement. The covenant is 2.5 times. We are light years away from these covenants. So that's the first part of it. It's 3.5 years to run. I think there is an extremely high probability, like we have every other year, we'd renew it at mid-year. But in the absolute worst case scenario, it's got 3.5 years to run. With Canadian short rates where they are today, that's about a 3.35 or something effective rate on it. According to Avery today, rates may be coming down. The short rates may be coming down in Canada. The other portion of debt that we have is that dark slice, which is $300 million US, 400 million Canadian. Long-term U.S. notes issue. 5.25 years to run on that. That's a 5 5/8 par bond that we issued March 17. We have swapped it to euro, so now for the remaining 5.25 years, that is a 3.28% interest rate. Again, and Lars could add to this if it's incorrect, but basically the covenants there, the covenant would be that we don't break a bank covenant. So it's an extremely firm, termed out, and as you're going to see in a second, very low interest rate set of debt. Now, maybe I'll skip this one for a minute and just come back, but I'll speak to the rate on this one. So 4 panels on this slide 36. The top half is Peter's research that, if you look at the left panel, we're sitting there at this a little bit over, I think you said 2.2 is debt to cash flow. It's probably about 1.9 or so debt to EBITDA ratio. And of course, that number would be an extraordinarily strong one in the old context of the industry. Now, 1.5 is the new 2.5, and that in fact is our long-term objective, to be at 1.5 times debt to cash flow. Probably for us, that'd be 1.3 debt to EBITDA. And so that rate on the upper left looks like it's relatively high within the sector, even though in absolute terms it's a lot lower number than the sector historically had operated at. But let's look at what we think is a much more important ratio. Look at the upper right panel, debt to free cash flow. Remember, in cash flow, you've got this chunk that has to go just to maintaining the rate in the company, because nobody really wants to get into a downward spiral in production rate. So all these companies are going to be at a minimum seeking to maintain their production. When you take that out of there, we're sitting a little bit at 4 times debt to free cash flow, which would put us at one of the very lowest levels in the sector. I think that's a far more appropriate way to look at it. But again, these are just the absolute dollars for debt and free cash. Then let's attach it to interest rate on the lower right. This is just out of the reported data. We have the lowest interest rate in this group. Then if you go to the lower left, interest coverage, which kind of takes that rate and works with the upper left, debt to cash flow basically, we would be relatively high in the sector. And again, something on the order of 5 or 6 times the covenant that we have. So it's really quite low cost debt. I'm going to back up one just briefly to get to your question about the delevering profile. So when the commodity price crash hit in 14-15, these ratios went up. We went up to close to 3 times debt to cash flow, which again, historically really wouldn't have been that bad of a number in the industry, but now this type of number would not be accepted. We delevered over about 5 years, a turn to around 2, and we continue to be headed toward our target of 1.5 debt to cash flow. Keeping in mind, though, the composition of our debt, the rate associated with our debt, and the fact is that it doesn't, we got extremely high levels of free cash. So then, let's look at the ultimate measure of how risky this balance sheet is, slide 37. So what we show here is the market rates that our notes have traded at. We are the bold red line on there ever since issuance. Now our debt has been becoming a little bit shorter term over this time, and that's probably, we were trying to calculate it, maybe 1/3% or something, 0.35, 0.4% you'd want to add back in, because we got a little shorter term, still positively sloped out there from 5.25 to index, which might be 7 or 8 years. There's 2 indices plotted in comparison. The dark blue is the whole U.S. economy, high yield for U.S. So it actually, credit spreads or rates actually came down a lot. Both credit spreads actually and the risk-free rate have come down. And we have, I guess, we have underperformed that whole U.S. economy for high yield. Look at the light blue line, though, for the E&P high yield. We have vastly outperformed the E&P sector, and we've done it, it's in the text box, a little hard to read there, but we've done it with 2/3 of the volatility of the sector in our notes. So this credit market is very, I think, efficient. I think it's very detailed, and it's very diligent about assessing the credit quality of these companies. Here's the market's assessment of Vermilion's risk. You put it together with low operating leverage, because we've got the highest margins, we got the most diversification, one of the lowest decline rates to go with it. I think that our financial leverage is represented here. The operating leverage mean that it is actually a very low risk company. That's my answer on the debt side.
Okay. Last question I want to touch on is sustaining capital, which is also kind of linked to the other two items. But you guys spent about $520 million in 2019. You've guided to 2020 capital expenditures of $450 million while keeping production flat. So that's a positive trend in your sustaining capital requirements. I guess just wanted to ask, what are you doing differently in 2020? And could you maybe talk a little bit as well why the sustaining capital calculation for Vermilion is different than some of your North American peers, just given your asset base?
Okay, for sure. I'll try to do it quickly. So you have to define the sustaining CapEx, and our definition is very simple. What CapEx number would it take for us to maintain production, the same millions of barrels equivalent for this year as compared to last year? So for this year, we got a $450 million overall capital budget. To keep the definition as simple as possible, there's three components to that $450 million. We would say that $410 goes to staying flat. We actually grow 1% under the $450 million budget. $410 million goes to staying flat. Just under $20 million goes to providing that 1% growth, and then just over $20 million goes toward long-term strategic projects that don't yield us anything in 20 and may not yield us anything in 21 or even longer, but they're there to set up what we think are higher returns and good value add for the long term. So, some seismic, maybe some drilling in Europe that has a long time to tie in, that sort of thing. We have that component in there as well. Now, typically, we always want to do some of that strategic CapEx, so that's $20 million kind of at this end of the spectrum. And then in the past, sometimes we've added that into the 410 and say that since we want to do the strategic spending and we want to stay flat, various times in the past we've defined that as $430 million of sustaining CapEx. I think to keep it simple and consistent with how most of the industry does it, I would call it 410 and then $20 million of growth CapEx. How do you do that? Well, one thing, we turn the growth rates down. We actually, again, using the same definition and making the adjustments for the acquisitions from 18 to 19, we'd say that we had something like a 2.5% growth rate for 18 to 19 at the 520. This year, and with the level of strategic investment that we had for the 19 program, we turned down the growth rate a little bit, and we further improved the efficiency of the projects, just like we've been doing for, really almost the whole decade. Since the early part of the decade, we have been smashing down this level of CapEx. It's represented on this slide 20 on the right panel, organic F&D, including future development capital. At the beginning of the decade, we were investing in the Cardium and the Duvernay projects like that. We shifted out of those more expensive projects where we had this $35 or sometimes higher F&D. We went into the Mannville Condi project in Alberta. We got in Southeast Sask, we got in Wyoming. We changed the project emphasis in Europe. So it's really a different project slate. This year's budget just continues that. Every year we've had a learning curve in costs as we've repeated these programs year after year. Certainly over this entire period we've had an improvement in services prices, no question about it. I think it's the least important of those three factors. I don't think it's a big one probably for us from 19 to 20. We don't have super big exposure to pressure pumping prices because we don't frack overseas, and only about half the wells even in North America are fracked. So it's really been those first two factors of changing the project slate and then secondly moving down the learning curve over time.
Good, and I see that with that we're out of time, so I appreciate the update. As usual, we covered some good topics, so thanks for dropping by this afternoon.
Yeah, thanks very much, Dave.
Thank you.